We're going to kick this off. Thanks everybody for showing up on this Thursday to hear about our Hanson Capital Opportunity Fund 3. We're excited to share how this fund works and kind of what we're working on. This has come together over the last probably 12 or 18 months of really honing in on this particular strategy. First, I want to introduce our team members today. We've got Ted Ost, relatively newer addition to our team, Managing Director of Investor Relations, 11 years in the business, very knowledgeable in private equity real estate. We've also got Chris Pike, Managing Director of Acquisitions. He's got 7 years on our team. One of the smartest guys I've ever met, really is going to dive into the real estate details themselves today. And last but not least, we've got Doug, Director Acquisitions, working with Chris Pike on year 3 right now. And let's get started. So first, disclaimer, all of you are encouraged to seek your own legal and tax advice. Past performance is not indication of future results. We've got legal and tax internally. We're doing this to the best that we know of the best people in the industry, but you should still solicit your own input before making an investment. The agenda for today, I'm going to walk us through the company background and history. I'm going to explain why we have some competitive advantages over some of our peers and why we think we're the right team to invest with, the fund structure and how that actually works. Then I'm going to hand it to Chris Pike to talk about the specific opportunity or investment thesis we're focused on today. And lastly, we'll go over the first 2 deals we've closed in this fund, Series 1. So first and foremost, the company. I came out of the mortgage banking business in 2008 when it slowed down rather abruptly, and bought the first credit card at a foreclosure auction at the courthouse steps, first residential home on a credit card. And that's grown to today to about $350 million. But that evolution has started with residential homes, switched into multifamily, the addition of a mortgage banking platform. We've developed retail, we've done office, we've built multifamily. We run a private credit operation that we've been running for 17 years as well. So we're not suggesting that industrial is the right investment because that's what we do. We are suggesting industrial is the best opportunity today. We've got the skill set and experience to kind of navigate through the marketplace. And we think this is kind of an unmatched opportunity that we're excited to share. With $350 million across our portfolio, that's 27 assets in the real estate arena, about 280 worth of real estate owned, and the other 70s specifically in the private credit. I really view 3 main buckets of real estate investment. For us, the lowest risk and lowest yield is going to be debt. We expect about a 10% annual return. Value add, which is the focus of this business where we're acquiring existing assets, is our middle bucket, and we allocate the most of our dollars right there. We think that's probably primed for the best returns, risk-adjusted returns today. And then lastly is development. Development should be the highest yield, but it also carries the highest risk. And with the marketplace today and general economic conditions, we're not doing a lot of development. We think the risk-reward profile is such that the acquisitions just outperform it today. Doesn't mean that doesn't shift. That's something we're always monitoring, but that's the focus today. Lastly, I want to highlight that at $350 million of assets, we are big enough and capable to be institutional quality and institutional quality people at everything we do, but we're still small enough that we can be nimble and chase opportunities and get ahead of kind of the bigger institutions as we go down that path. One of those differentiators I'm speaking to is the full vertical integration that we've have the capability of doing. All of our departments are built around an expert that's leading it, that's got extensive experience. Our legal is headed by Zach Price. He's been with us for 15 years. Our lending platform's got 11 years with Tiffany Harper, dedicated to managing that business. Our property services division, led by Jim Tainter, has got over 40 years managing billions of dollars at single family office to the largest institutions. And last but not least, Michelle and our accounting team, she's got 4 CPAs under her. Accounting is so critical, and how all these pieces work together truly gives us a differentiated advantage to be able to go and execute on real estate opportunities that we see. Last differentiator, I think, is that our structure is very simple. We didn't reinvent this wheel, but a lot of private equity groups make this really complicated. For us, our partners, our limited partners, are going to take 75 cents of every dollar that's earned in profit. The company is going to take 25% for doing it. And how we make this completely aligned is over the course of the years we've been in business, I have become the single largest investor. My single family office invests on the LP side of the investment in the partner side, just like you, which keeps our interests aligned. And it also keeps us focused on fees. We took our fees, traditional would be a 2-point buy fee. We take that down to 1.5. Instead of 2% asset management, we run it on 1. Our size allows us to be a little more efficient with fees, and we want to make our money on the real estate, not just the fees. So what you'll see throughout the trend here is interest alignment, and the fact that I've been able to create the wealth that I have to be the largest investor makes it seem like a privilege that I can share these investments with you and keep all of our interests aligned. I want to notate that there will be Q&A. There's a Q&A button at the bottom of this. You can click in, type questions. We're going to do Q&A at the end, and then Ted will interrupt if there's something pertinent as we go. So don't hesitate to write questions into that as we move along. And with that, I'm going to pass it to Chris Pike to start to explain the opportunity.
Thanks, Chris. So today our focus or our investment thesis is centered around small bay industrial opportunities. For those of you that are not familiar with small bay industrial investments, when I say that we're focused on multi-tenant business parks, typically you're looking at, call it roughly 100,000 or 200,000 square foot business parks that are made up of multiple tenants that have bay sizes anywhere from 1,000 square feet to 25,000 square feet. The types of tenants that occupy this space, you can think of contractor space like HVAC contractors, pool contractors, some light manufacturing uses, as well as occasionally you get a last mile distribution type user in there. In terms of why we're focused on bay sizes under 25,000 square feet, is there's a massive lack of supply in that space today. If you look at this chart, you'll see the recent supply pipeline in the industrial space. And as you can see here, a majority of the new supply in recent years has been focused on bigger box development of bay sizes 100,000 square feet or greater. And less than 2% of new inventory has service bay sizes under 25,000 square feet. And we focus in growing metropolitans like Phoenix, Las Vegas, major metros in Texas like DFW and Houston, and in these markets where there's growing population and more businesses that need to service that population, and there's been limited to no new supply being added, it leads to a very tight vacancy market. As you can see here, bay sizes under 25,000 square feet have been hovering around 2% vacancy. And then the bigger box product of 100,000 square feet or greater is anywhere between 7 and 10% due to the fact that it's the bulk of the new supply, right? And that 7 to 10% is dependent on your submarket and your bay size. And so with that, we have a huge supply demand imbalance. You'll see in this chart, the red line is bay sizes under 25,000 square feet, and it's demonstrating asking rents for base or industrial product at various bay sizes, right? So you can see here, the small bay product has been leading the charge in terms of rent growth. And if you look at the purple line, its bay size is 200,000 square feet or greater. And again, all industrial products saw some pretty massive rent growth on the tailwinds of COVID, but the bigger box product that's seen the new inventory is starting to flatten out and even soften due to some oversupply. In alignment with this supply-demand imbalance, we also see some opportunity in the fact that historically there's been limited institutional competition in the small bay space. These bigger institutions, they typically focus on bigger box product. And the reason behind that is the simplicity of the management. They'd rather manage a 500,000 square foot single tenant building rather than managing that same 500,000 square feet chopped up between 50 or 60 different tenants. From a management headache standpoint, they're looking to deploy as much capital as efficiently as possible and don't want to deal with management headaches. So what that's led to is a lot of unsophisticated ownership. When I say unsophisticated ownership, I'm not saying that these people aren't intelligent. What I'm saying is it's a lot of long-term owners or maybe people that have inherited a property that aren't necessarily real estate professionals. So a lot of times these people focus on keeping their tenants happy and keeping them in place rather than keeping up with improvements and keeping up with market rents. So that creates an opportunity for us to identify those assets, come in and acquire them, execute some capital improvements, push rents to market rates, as well as implement more of a institutional management structure that bills back for CAM charges or operating expenses that may not have been historically billed for, and really drive bottom line net operating income and force some appreciation. So in addition to another key differentiator that Hanson did not get to mention is our acquisitions pipeline. Our team employs a comprehensive marketing efforts across phone calls, text, emails in order to stay in front of our broker network. Today, our broker network consists of over 1,300 brokers. In a typical month, we see roughly 1,000 deals a month, and anywhere from 10 to 20% of those warrant full detailed underwriting because they fit our thesis well and we like the basis. This leads to roughly 5 to 10 offers a month that we submit and ultimately securing about one deal per 2,000 deals that we look at. So we're casting a very wide net to find the deals that really fit our criteria, and we're taking a systematic approach to reviewing a vast volume of opportunities that allows us to distinguish the best deals. The selectivity led us to a pause in buying for the past few years due to market conditions. And when I say a pause in buying, it didn't mean we stopped working or that we stopped looking at deals. Deals were simply not penciling where our leadership team was comfortable moving forward. They were not meeting our strict underwriting criteria, and therefore we didn't move forward with them. And I think you'd be hard pressed to find other sponsors in the space that took that long of a pause over the recent years due to volatility. So today I'm going to dive into the opportunities within Series 1 of our Fund 3. When I say series, for those of you that do not know what that means, in our fund, you're investing in specific deals. It's not a blind pool fund. It's not a discretionary fund. You are taking your pro rata ownership of specific assets that are allocated into a series. So the first series is made up of these two assets, 9365 McKemy Street in Tempe, as well as 9863 Tanner Road in Houston. And these two, there's always two requirements that we're focusing on when we're looking at new acquisition opportunities. We're always looking for opportunities that are below replacement cost. We want to buy existing assets that are below replacement cost, and we're looking for in-place rents that are below markets. And if a deal doesn't have both of these criteria, we're not chasing it. And both of these two deals fit this criteria to a T. So the first asset in Series 1 is 9365 McKemy Street. We closed on this purchase the week before last. We paid $188 a square foot. Just for reference, we saw property trade last week just north of $220 a square foot. That was a value add opportunity that needed a significantly greater amount of work in order to bring it up to market rates. Replacement costs on this building would come in, call it roughly $250 a square foot at a minimum. So we're acquiring this property significantly below replacement costs at our purchase basis of $188 a square foot. It's got a strong infill location in Tempe, right next to the 10 freeway. It's in the Southeast Valley, which is a growing part of the metropolitan, so it's well positioned to service a lot of the affluent residential growth that's occurring in the valley, in the Phoenix Valley. And it also has some strong differentiators, right? That makes it a very appealing building to tenants in the market. That includes 6,000 amps of power, which is very heavy power for a building of this size. It has 100% HVAC, so both the warehouse and the offices are completely AC'd. And both of these things are highly sought after by tenants in the space, making it very appealing to tenants in the market. In terms of the business plan, our business plan on these small bay assets is executing make-ready improvements and making modern spaces that are move-in ready. And this is the key to the small bay investment thesis, because a lot of these tenants that are looking for this small bay space, they're looking for space yesterday. They're not, a 100,000, 200,000 square foot tenant that's a massive corporation planning moves 12 or 24 months in advance. They need space and they need it now. So the prior owner was looking for a single tenant to occupy this building, and it's not set up as a single tenant building. It's got 5 separate entrances, 5 separate offices. It wasn't necessarily fit for a single tenant building, and it was creating struggles for him to lease up the property. So what we did is we stepped in, reworked the marketing for the smaller bay sizes, and executed a light make-ready improvement plan. So we're not doing massive construction here. We're doing things like exterior paint, reseal of the asphalt in the parking lot, and restriping the parking lot. And then we're doing some basic interior improvements like, painting the inside of the warehouse and painting carpet inside of the office spaces. And like I mentioned, we're just making a clean, modern, move-in ready space so the tenants can move in quickly and minimize our downtime and maximize revenue here. Something that was unique with the McKemy asset, we typically don't chase 100% vacant buildings. The reason we did so with this opportunity is we were able to set up an extended escrow period with the seller because he needed some time to go identify a 1031 exchange opportunity. So this allowed us to step in, start executing our business plan while we were in escrow. And we actually successfully leased 4 of the 5 bays prior to closing. So, this is a great execution heading into closing on this asset, like I said, a little over a week ago. From a return standpoint, we acquired this asset at just under 8.5 million. We put approximately $600,000 into the capital improvements that I mentioned. The loan terms we were able to secure, we secured a loan at 62% loan to cost, 5-year fixed rate at a 6.75% interest rate with no prepayment penalty. These are very attractive loan terms, especially when we're getting it quoted. It was 100% vacant, right? And the only reason we're able to obtain these types of loan terms that the general public typically cannot is because Hanson's signing personal guarantees on these properties. We are also one of our bank's largest customers, and so we get access to loan terms that most people are not. And if you want to talk about alignment, when our owner of the company is signing personal guarantees, it doesn't get much better in terms of alignment than that. In terms of projected cash on cash returns upon full stabilization and 100% occupancy of this asset, we're looking at a 4.6% cash on cash return to our investor level investors and a 6.5% cash on cash return to our institutional class investors. And on a 2-year execution, we're underwriting a projected 25% IRR and a 1.5 equity multiple over a 2-year execution. The second asset in the series is 9863 Tanner Road. We closed on this asset earlier this year. We acquired this asset significantly below replacement cost at $78 a square foot. For perspective, we're seeing similar trades in the market occurring at $125 a square foot or greater for similar metal product that is a value add opportunity. The asset itself is in an infill location in Northwest Houston near the 290 freeway and the Beltway 8. So it's got easy access to the rest of the metropolitan. And Northwest Houston is a premier market for small bay industrial assets in Houston due to a lot of affluent growing population. And so a lot of small bay users want to be near that population growth so they can service that population growth. And they also like to be in that 290 or Beltway 8 corridor so they can access the rest of the metro. In terms of business plan, this is the typical private capital owner story that I mentioned higher up when I was talking about our thesis. The gentleman that we purchased this asset from had owned it for an extremely long period of time, had a great basis in the property. So he had no need to come in and execute improvements or push rents to market because he had such a low basis. So when we bought the property, it was 100% occupied at closing. The average in-place rent across the business park was 27 cents a square foot. And we're seeing other people in the market achieve as high as $1 a square foot for similar spaces. We underwrote on achieving 83 cents a square foot on average across the business park. And today we're near completion of exterior make-ready improvements. And we're working to renew tenants where possible. And we've already locked in a few renewals with existing tenants. And then when we have tenants that do not renew for one reason or another, say we don't like their credit or they're not a good paying tenant, or for some reason or another, they're not able to afford our new rents. When they vacate, we come in and execute the interior improvement plan that I mentioned that we did on McKemy, and replace them with a new tenant at market rates. So we're doing things like painting the warehouse and improving the office space with new carpet and paint and leasing it to a new tenant at market rates. In terms of returns on this opportunity, we acquired the building at 6.6 million. We underwrote putting approximately 1.3 million of improvements into the building. We secured a loan at 59% loan to cost. Again, it was a 5-year fixed rate loan at 7.25% interest with no prepayment penalty. I'd like to reiterate these terms are not achievable with the in-place revenue that was so low. And without the personal guarantee from Hanson, we wouldn't have been able to obtain these terms at such a, attractive rate and high LTC in comparison to what's achievable for other people in the market. From a projected cash on cash returns standpoint, upon stabilization, once we turn over all of the units within the building, we're looking at a cash on cash return for class investors of 8.7%. And for investor or institutional class investors, we're looking at cash on cash of around 11.6%. And again, we're underwriting a 2-year execution on this deal, which produces a 25% IRR and a 1.5 equity multiple based on our underwriting. I appreciate you guys taking some time to let me talk you through these opportunities. Obviously, I ran through this extremely quickly. We're happy to dive into this in more detail, and I'd highly encourage you to schedule a follow-up call with our team so I can walk you through some more details or answer any questions you might have on it.
Thanks, Chris. That's the opportunity in a nutshell, guys. We're so excited about what we're doing with these industrial deals. They're playing really well into our hand these days. The opportunity to buy these things below market, below replacement cost, and with below market rents is turning into something that we thought would work. We've done it over the last few years, but what I'm probably most excited about today, other than how these deals are coming together, is we recently entered escrow. We had 27 offers and worked a portfolio, 8 properties out of our first industrial fund into one assembled portfolio. And it's giving us I'll say the accretive growth that each of these buildings individually would have not been attractive to an institution. And the company is a company that you wouldn't know the name of, but they are 100% backed by JP Morgan and JP Morgan's alternative platform. So we effectively have one of the biggest banks in the world that won out on a bid to provide capital to buy and acquire an assembled portfolio for us. So each of these deals that we're going to buy is built to stand on its own underwriting. These deals work. Those 2 that we're excited about that we just closed are very representative of the exact strategy that we're going after. It's multi-tenant, given that diversified cash flow. We're going to buy below basis, so cheaper than we can build it, and we're going to be able to raise the rents. And the fact that we're now in escrow to sell an assembled portfolio is just further validation of the thesis. If you can buy these individually, assemble them up, which is the trend. That's what we did with residential homes when we started at the auctions. It's what we did with multifamily. It's now what we're doing in industrial. We're just really excited to share that opportunity, and we thank you for your time today, and we'll jump into some questions.
Yeah, we've got a couple that came in, guys. First one, what is the fee charged to the investors for Hanson's personal guarantee?
That's a variable. It depends on market. Sometimes it's nothing. Sometimes it's 2 points. Depends on the extent of what all the guarantee encompasses. Sometimes they'll have me sign a full personal guarantee. Sometimes it'll be limited recourse. So there's a range, and we would go solicit guarantees from other groups before we would finalize what it would be.
Okay, perfect. What state are most of your properties located in?
Most of the holdings today, or all the holdings today, are in Texas and Arizona. We've got Chris Pike sits in LA full time to be closer to the capital markets. We like California as a market, but we think it's on sale right now. But we're not thrilled with some of the political decisions and how it's affecting real estate. And then we're also active in Utah, Nevada, and Colorado.
Can you talk about investor reporting if you participate in the fund?
Yeah. So we operate on Yardi, which is kind of the institutional gold standard for investment management. It's an accounting system like a QuickBooks, but on steroids. So it actually works for our property management company to do all the rent collection, APAR, all that type of work directly with the tenants. And that system talks directly to our investment management system, which has waterfalls and all the ownership splits of our partnerships. And it's all in one integrated system, so we can provide live and real-time accounting that's accurate amongst all those different areas.
Perfect. How long is the investment hold period? Do you put out distributions monthly or quarterly?
We're really excited that we pay out monthly. Being the largest check writer, I don't see a reason to wait quarterly to get paid. I like getting the distributions every month. We've got a really deep accounting team such that we're on top of that stuff full time. So we believe monthly distributions is the best answer for that. In terms of a hold period, every deal will have a estimated hold period. Both of these deals we just explained are 2-year or 24-month holds is what they're underwritten to. That can change depending on market conditions or, a number of other factors. But I think it's worth noting that our funds do have a sunset. So then what that means is there is a defined liquidation period at the end. In our case, it's about 10 years. If we were at that point and half the people want to leave and half the people want to stay, we would facilitate a recap or some sort of a buyout to make sure that the ones who don't want to sell have the ability to keep their investment going, but the ones that do want to get out have an opportunity to do so.
Perfect. Are these net leased properties?
I can step in on that one if you'd like, Chris.
Go for it.
Yeah, it depends on the property, right? A lot of times we're acquiring these assets, they have a gross lease structure that's in place and we're converting them to net leases. Or sometimes we do find something that has a net leased structure that's in place. So it's really dependent asset by asset. But in majority of markets where it makes sense to do so, we are converting these assets into triple net leases.
Perfect. We're gonna go to Dale's question. When do I invest? When you find a project, or does our money sit idle until properties are found?
Yeah, great question. So because we have our debt platform, we take commitments full time. That being said, the money gets deployed into the equity deals as they present themselves. So it's probably worth a more one-on-one call because I could explain this concept for a long time. But we have the ability to take cash in and get it deployed into hard money, yielding, I'll say, 8 to 10% while we wait. And then we have credit facilities set up against that. So we can tap that equity against the asset being the loans. We can deploy that equity as the down payment on the actual real estate investments.
Minimum ticket is 50,000. Would you want to talk about how is the structure of the deal? Would I be an LP and you will be the GP?
Yeah. So say that question again, Ted. Sorry, I couldn't capture that one.
How is the structure of the deal? Would I be a LP and you will be the GP?
Yeah. So it's a series limited partnership is the legal entity that we use. All the money we raise is contributed on the LP side of the table. So I write a check as an LP investor, just like everybody else would. The general partner is a management company that makes the day-to-day decision making, and it helps shield our investment capital from liability if we were to make a mistake or something like that. But yeah, everybody is on the LP side of the table. Our company is the GP.
Perfect. And it looks like we have time for one last question here from Dale. You said the environment has not been ideal the last few years. What has changed?
Yeah, that's another great question. The environment not being ideal today, I would be referring to, I was talking about ground up development. The ground up development specifically, it's not our favorite time for it, just because there's a lot of supply chain issues and other uncertainty relating to the building or construction products or inputs for development. And we've also been in an escalated interest rate environment. It's no shock to anybody that commercial real estate is totally tied to interest rates. And as the interest rates got more expensive, we're seeing more and more default and other kind of negative press on the topic. One of the reasons we like this so much and why we're so focused on the below replacement cost is when we can buy these buildings below what it costs to put new inventory in the market, it allows us a high degree of safety in the sense that we can rent at a lower rate than somebody else could rent if they went and built a new product. So when we've got a below market basis, it gives us kind of a safety net. One, nobody's able to go put new product to compete with us at a lower price. And therefore that kind of guarantees they couldn't do that and undercut our rents and bring rents down, because commercial real estate is valued as a function of what the income it produces. The lower basis we can get and the higher we can push the income, the more we can push our values. And in today's environment, those have been very stressed. There's case studies that we'll share that are in our deal room that if you're on this webinar, you've been given access to it, that show this isn't like an idea that we think we can go do. We've bought these buildings, we've pushed the rents up, we've created the income. And during this last few years of what's been a tough environment for commercial real estate in general, we've been creating wins and creating a lot of value for our partners by executing this exact strategy.
Perfect.
So it looked like we got through most of them, Ted.
Yep, we did.
Okay. So with that, we'll leave today, and we really appreciate you guys attending. We encourage you to schedule a call with us. You will probably hear from Ted on a follow-up regardless, and we're happy to spend as much time as we need working through all the questions and answers of the fund to get you the information you need to make an investment decision. Thanks again.